The average person isn't a millionaire, but you can be just by being average. It's true, being average can make you a millionaire, and yet your average person doesn't get there. Meanwhile, a lot of people actively trying to find money strategies to do better than average never get there either. That's because you don't need to be a crypto guru, day trading expert, or YOLO a bunch of options from Wall Street bets to become a millionaire. In fact, those approaches can actually make your chances of getting the millionaire status statistically worse. Instead, I'll show you the most simple level strategy designed to help you build a net worth of $1 million or more. One so simple, the folks on Wall Street hesitate to tell you, likely because you'd realize that you could become a millionaire without them. Think about it. We're encouraged to think of big name investment firms and famous investors as if they're the Michael Jordans of investing, elite performers that can help us make millions. And they get us to focus on their skills as if picking the next big stock is like shooting a three-pointer from midcourt. There were and are some superstars in the industry, but they're few and far between. And they're likely not the ones who'd be actively managing your money. Plus, here's another secret. Those big name companies who actively manage stocks and mutual funds, they don't consistently deliver above average returns. Now, we often think they do, as they may massively promote their few winning funds while quietly playing down all the funds that lose money. And as a result, we just see more of the winners. And even if you get average returns from these places, they often charge high fees on top. And those fees can bite into any average returns you actually get. At the end of the day, you actually may be below average. So the best way you can win, pick low fee index funds. So you too can be just average. What do I mean by average? And how do you get average returns? Historically, the S&P 500, an index made of the top 500 companies in America, has returned about 10% per year on average over the long term. Now, some years it's up 30%, some years it's down 20%. But over the decades, it averages to be about 10%. Now, accounting for inflation, that number becomes more like 8 to 7% in terms of real returns. So that 8 to 7% is basically considered average. So with index funds that track the S&P 500, you're literally getting average market returns. And here, you're not trying to beat the market, pick winning stocks, or time anything. You're just showing up. And historically, that's been all you need to do to build serious wealth. By being average, studies show that you'll beat most people and investment firms trying to beat the market in the long term. Want real proof? Warren Buffett famously made and won a $1 million bet with a co-founder of a hedge fund. The bet was that a low-cost S&P 500 index fund would outperform a hand-picked selection of hedge funds over a 10-year period. Buffett won decisively. In fact, the firm conceded the bet even before the decade was over, as the results were overwhelmingly in favor of the index fund. Okay, so now we know that being average beats active investing. And I said the S&P 500's average return is around 8%. So, how does that make you a millionaire? The answer? Compound interest. Albert Einstein is known for calling compound interest the eighth wonder of the world. He wasn't wrong. Here's how it works. When you invest money, you earn returns. But here's the magic part. Those returns start earning returns too. Then those returns on return start earning returns. It's like a snowball getting bigger as it rolls downhill. Let's say you start saving and investing at age 22. You decide to invest $500 a month. Not a huge amount, especially if you're living with roommates and keeping expenses low. But if you do this from age 22 to age 65 and earn an average annual return of 8%, you will have invested $258,000 of your own money. But your account balance? Close to $2 million. You put in $258,000 and compound interest did almost $2 million worth of heavy lifting for you. It turns out being average can make you a multimillionaire if you start early. Think about it. With historical market returns, you can likely get to millionaire status. And you can do it without taking the risk some of your peers might be taking on. Let's look at some of those. Crypto. Crypto offers the potential for very high returns, but it's highly speculative. It's estimated just over 240,000 individuals with crypto holdings are worth $1 million or more. Meanwhile, many altcoins have come and gone, leaving a lot of investors disappointed. Day trading. About 1 to 10% of day traders consistently outperform the market. Less than 1% can perform consistently over time. Meanwhile, the vast majority lose money. Sports betting. Sports betting has the lowest probability of you becoming a millionaire. You have virtually zero chance for long-term wealth building. In fact, research from the CFA Institute found that 96% of gamblers lost money online. Now, based on those stats, do you really want to take some of those risks? While it may look sexy, glamorous, and you feel like you're actively working and taking the initiative to be rich, the numbers are simply against you. The pattern is clear. Start early, stay consistent, and let time do the work. So why stress about it? Just get average returns. And because only 3% of Americans are millionaires by net worth, when you become a millionaire, statistically, you won't be average anymore. Now, if you found this helpful, drop a like and subscribe for more content on building wealth. Thanks for watching, and I'll see you in the next one.